Are you new to the stock market? In this video, I'm going to be talking to you about all the basics of trading in the markets. This is part one in a short series, and by the end of this video, you should have a basic understanding of the market, some of the terminology traders use, and by the end of the series, you will have the knowledge to complete some simple, profitable trades by yourself. Stick around to the end of this video for a friendly competition and the end of the series for my top tip on how you can start making money today. Hello and welcome. I'm Wayne from WES Investments, bringing you stock market news, portfolio updates and training all on this channel. So if you're new here, consider subscribing. So in this video, we're going to be going over candle and candle charts, comparisons and indices, Yahoo Finance, terminology including going long, going short, uptrend, consolidation and downtrend, support and resistance. And finally, we've got a friendly competition at the end.
So here we have a standard candlestick chart, and it could well look a bit overcomplicated at the moment, but let's try and break down some of the elements for you, and hopefully it'll all make a lot more sense. So here is a very simple candle diagram. Here we have what is called a candle. These bits that stick out at the top and at the bottom are called the wicks. On the right you can see that we have the price, and on the bottom you can see the timescale. Now remember that the candle chart you set the timescale to is one candle for that timescale. So if, for example, you set the chart to a 1 day chart, that will mean that one candle will represent one whole day in the market, and obviously 1 hour will be one candle is 1 hour. There are two different types of candles, a red candle and a green candle. A green one means that the price has ended higher than it opened, and that's called bullish. A red one means that the price has ended lower than it started. So let's start by going over the green bullish candle. Now we start the candle down here at the bottom. This is where the time period started. So be this obviously 1 day, 1 hour or 1 minute. At the start of this time period, the price was 102. And at the end of the period, which is up here, the price was 105. Okay, do you see that on the top there? So we've started the period here, and it's started at 102, and we've ended the period at the top of the candle here at 105. During the time of the market being open, so between the start and the end, the price has fluctuated to the extent that it's gone down to this lowest point here. So at its lowest point during this time period, it was 101. And it's also gone all the way up to here at some point, and its peak during this time period has been 106. Now, if you're struggling to put that into perspective, let's just take a little look at this line chart here. So this is the exact same candle, and it started here. We've travelled down to 101. We've travelled up to 106, and we've ended the time period at 105. Okay, so that would be, again, this would be a green candle here with wicks that come up to the top and that come out to the bottom here as well. Now, let's flip this round to a red bearish candle. Same elements again, but this time we start up at the top here at price 105, and we close at price 102. We have the same highs and the same lows. And just for visualization, here it is with a line chart again. So starting, going up, going down, and then coming up to the end price here.
In a moment, I'm going to show you the candle chart on eToro, because eToro is all about making this as easy to read as possible. If you're new to trading and you're not already on eToro, I would recommend opening a demo account on there to help you learn the basics. Even if you're going to move on to other platforms in the future, eToro is a great place to learn because of the simple nature of the platform. I'm going to use Amazon as an example here, but all charts are the same when it comes to this information. Different platforms will have some different elements to them, but most of them will have the same basics. Looking at a chart here, this is the Dow Jones. You can see all the candles as I have described them before. Now, I hope you can see these candles and know that in these particular time periods, we've started here, we've ended here, and we've fluctuated between these 2 points. Just to show you this over another way, I'm going to move the chart to a 1 hour chart. So let's just explain the timescale change up. Up here you have the option to change the candles from 1 minute up to 1 week. You really just use the timescale based on the frequency that you trade. Once you have your trading or investing strategy, you will find that you will end up mostly using one particular timescale. For me, it is a 1 day chart, but I do sometimes flip to different time periods just to watch the progression. Moving to the 1 hour candles, I want you to look at this chart and think what colour the daily candle would be for this particular time period, based on what you can see here. Where would the candle start and where would it finish? What would be the top of the wick and what would be the bottom of the wick? Now, not all charts are based on the exact same timescale that you may think. For example, the daily chart for Bitcoin actually starts at 10 p.m. So it would start here and the current candle would be around here. It would have a high up here and a low right down here. So remember that the candle is a sum of all of the candles from within.
I just thought I'd play this little clip for you here, and this is basically just a 1 minute time scale, and you can see the candles moving here. So as you can see how the candles are forming, the price has gone up here and up again, and when it drops back down in a second, you'll see that it will leave a wick just up the top here. Yeah, there it is, there we go. Okay, and then when the next candle starts in a second, here we go, boom. And another thing that's important to notice is that the next candle does not necessarily always start at the end of the last candle. So for example, this one ended here. By rights, this candle should have started here, but it didn't, it came up here. Okay, and the same over here, look, you've got this drop, and then the next candle climbed before it dropped further. So this one ended here, dropped down to here. This one dropped here and then jumped up slightly. This one's even better, look, it dropped down to here and then somehow found its way back up to here. Okay, so it's important to note that the candles do not always tally up next to each other, and that's especially so in stocks because of the fact that they're not 24 hours. So it means you will often get a lot of activity when the market's closed. And something else to notice is obviously this candle finished right the way down the bottom here. Okay, the next candle, even though it finished higher than the last candle, is still red. Okay, so it doesn't necessarily mean just because you have a red candle, it doesn't actually necessarily mean it's a bad thing, because the price has gone up. Okay, so if you're buying in this situation and you bought here and then you've got a red candle, it's not a problem. It's just the colour of the candle there is just to show you which way it's moved.
Comparisons and indices. Now, when you are looking at the chart of an asset, there are a number of different things that you can use. Firstly, comparing two or more assets can be very beneficial. For example, comparing how a stock has performed against the wider market. So if, for example, we consider a stock like Games Workshop, we may want to compare it to the wider UK market, and you may also want to compare it to the rest of the world. We can do that by using the indices. If you don't know what the indices are, then after this video, have a quick Google. However, in a nutshell, you have probably heard of the FTSE 100, the Dow Jones and the Nasdaq. These are all what we call indices. That is a selection of the biggest companies listed on a specific stock exchange. So the FTSE 100 is the 100 biggest companies that meet a set criteria listed in the UK stock exchange, and the Dow Jones and Nasdaq are both US listed companies. However, while many of the companies listed on indices are normally global companies, they normally are heavily tied to their own country, whereas American companies listed on these are truly global companies. The Dow Jones, for example, has the likes of Apple, M3, Disney and McDonald's, while the Nasdaq is more tech heavy. It includes Apple as well, but also Activision Blizzard, Amazon, AMD, Cisco. So you get the idea. These are all very global companies, and they can be very good at judging how a stock is performing compared to the global market. So this is why I normally try to compare a stock to its local indice, as well as the Nasdaq and the Dow Jones. So here we have the Games Workshop chart. If you click here, you compare with other stocks. So here I add the UK 100, also known as the FTSE 100, as well as the Dow Jones and the Nasdaq. It depends on your investment period and what level you compare these. Moving the chart to the current month, for example, may be useful if you are looking at monthly performance. However, if you are a long-term investor, you should always consider that shorter periods may not be as relevant. For example, as a long-term investor in Games Workshop, I know that there are often long periods of stagnation for the stock over a few months as enthusiasm wanes, until something else happens and then the stock pops again. So this can often mean that looking at the period of 1 month, you could think this stock is performing badly, but then when you move out to the wider view, it looks much better. It is important to know market times when looking at candles, because the candles are only for when the market is actually open. Prices still change when the market is closed, and I'll go over what moves a price shortly. But there is also a way to know the price of some stocks when the market is closed. This is called post-market price and the pre-market price. Next, I want to introduce you to Yahoo Finance. To find it, just search Yahoo Finance. It comes up on all search engines. Yahoo Finance, to me, appears to be the best platform for providing all the information. There may be paid-for platforms out there that might be slightly better, but for me, this is the easiest to access and has the most information in one place. So this is Yahoo Finance. Let's go through a few important bits of information. Firstly, if you want to know about a company, you can type the company name into the search bar here. On the left, you will see what is called a ticker. This is the symbol for the stocks. You will also see that there are a number of different stocks here for the company. On the right, you will see the stock exchange that they are listed on. The top listing is almost always the home stock exchange. These other listings are the stocks available on other exchanges worldwide. The reason for this is to allow people in other countries to invest in a stock in their own currency. For example, if you are in Europe and wanted to invest in Games Workshop, you would be able to invest in one of those using euros, rather than having to change your money into Great British pounds. Buy into the UK stock exchange. Then, when you decide to sell, you have to change your money back again. There are lots of costs involved there, as well as time and effort, so it's much easier to just use a local listing where possible. For eToro, we don't have to worry about that, because eToro turns everything into US dollars, so it makes it much easier to trade and move around cash from country to country with different stocks. So you will see here under the company name is the stock exchange the stock is listed on, and also the currency it's traded in. Next, we have the current share price. Now, remember that the actual share price is not a good indication on the value of a company. For example, a company with a share price below this is not necessarily worth less. The part that indicates this is the market cap. Market cap means market capitalization, and this is the value of all the shares in existence. This is worked out by the total number of shares multiplied by the current market price. There is also other important information like earnings date, dividend amounts and dates. Then, over to the right, for me, is one of the most important parts. It shows the earnings and revenue in an easy to see graph. As I've said, there is a lot of information here, and I could do a whole other video just on Yahoo Finance. So for now, I'll leave this here, but make sure to take a look and learn as much as you can from it. Use Investopedia and Google to help you with any terms that you don't understand. So some terminology now. Just to explain a quick couple of trading terms: going long, going short, uptrend, consolidation, downtrend, support and resistance. So going long is when you're planning on buying an asset and holding it because you are expecting the value to go up. This is the standard way to invest. And on eToro, this is simply just clicking the buy button. Going short is when you sell an asset that you do not own, with the intention that you will buy it back at a lower price. Let's say, for example, I own 10 shares in Amazon, and you think it will go down in value. What you would do is make a deal with me that you would rent the shares from me and then pay me a set amount per day for these shares. For the purpose of this demonstration, let's say 10 cents per day. You then go to the market and sell these shares at the market price. And let's say that that share price is $30. So you've sold those 10 shares for $30 and you now have $300. Let's say 1 week later the price has dropped to $20 a share, and you decide that that is enough. You buy back these shares for $200 so that you now have $100 in cash and the original 10 shares that you owe me. You give me the shares back along with the 70 cents that you owe me for the interest that we had agreed. That's 10 cents over 7 days. I'm happy because I've just made 70 cents for doing nothing. I still have my shares, which I believe are going to be worth $60 a share in a couple of years. Whereas you're happy because you have $99.30, which is your $100 profit minus the 70 cents in interest. Now, all of that sounds complicated, right? But if you're on eToro and most other trading platforms, they've also made it easier for you too. But let's have a look on eToro. So to short a stock, let's say Amazon here, you just click sell. And then you can see there is a small print down here at the bottom. This is the price you will pay in rent for these stocks. You will also see that there is a price difference. This is called the spread. You have the price to buy the stocks and the price to sell the stocks. Now, remember, for a normal transaction, you would buy the stocks at this price. Then, when you decide to sell the stock, you would do it at that price. However, when you short a stock, you are first selling the asset that you are borrowing, and you will then need to buy it back at the close of the transaction. Now, remember, if you open a transaction, then to close it, you must close the trade. Do not click buy or sell buttons because that will open up a new trade. Uptrend, consolidation, and downtrend. So these words are fairly self-explanatory. Uptrend means that the overall direction of the price is upwards. Downtrend means that the overall direction is downwards. And consolidation means that the market is like taking a rest. So you should view the market as organic. In nature, there are no straight lines. And this is also the case in the market. It moves in waves, okay? You will see from any chart that there is no stock that just moves in one direction. Even when it is moving upwards, there are times when it will dip down before it continues back up again. I think the best analogy I've heard is saying that the buyers or the sellers are getting tired. Okay, so if it's going up, your buyers get tired and it causes a drop, and then they get their energy back and it climbs back up again. Let's have a look at a chart so I can show you what this means with trade. Now, these three top charts are solid uptrend. You will see that each of them trends up, has some consolidation time before it continues the uptrend, whereas the others are all trending down. They consolidate a little and then continue to drop. It is my opinion that the companies on the top are the types of companies that you buy, and the companies on the bottom are the companies you short when the overall market is in a downturn. Many people will tell you to buy value, and often these companies at the bottom will look like they are at a discounted price. But as always, if something is cheap, there is a reason for it. If something is expensive, there is also normally a reason for it. Support and resistance. This is to help you to understand when a stock is looking like it might move in one direction or the other. When a stock is in its consolidation stage, it will build up a bottom, which we call support, and a top, which we call resistance. If you imagine that the market is in a constant battle between the bulls and the bears, and the bears are trying to push the market down, and the bulls are trying to push the market up. Every time that the price starts to drop to a certain level, the bulls call in support and stop it going too low. Now, what this means in real terms is that there is someone or a group of people with a lot of money out there that think that the support price, the stock, is a complete bargain. So every time the price drops to that, they buy up all the shares, pushing the price back up again. However, every time the bulls push the price up too high, the bears launch the resistance. And basically what that means is that either the people who are buying the stocks when it reaches the support price now think that it's overvalued and are selling off their stock. It can also mean that there are not enough buyers out there that think the stock is worth more than the support level. There could also be people who are shorting the market when it gets to that resistance level. They think the company is overvalued at that price and they start to short it. This means that they are selling a share back to the market, which drives the price down. Chances are they are day trading this and are closing their position as it gets to the support level. So let's have a quick look at some charts. So here we have the USD and Great British Pound chart. Currencies tend to show this a lot easier. So you can see here that the price is spiking up. It hit a high, or the resistance, and then falls back down again. It falls down to a support level and bounces off that. What you normally expect to find is that when something breaks through its support or resistance, it then has a bit of a free run, because whatever the reason that was stopping that movement has now stopped. Obviously, this is in theory. It isn't always the case. Well, if you stayed here this long, then firstly, thank you for watching. Now for our competition. There is no prize involved other than the bragging rights, but I really hope that you will play along, as it would be really great to see what level you guys are at with your trading or investing, and what level you guys decide to enter the market and where you leave. So the backstory is that you found a company that you think is a great investment. You see a lot of potential in this company and you see it doing well over the next few years. Its current share price is higher than many investment calculations would value the company. So there are a lot of people that are saying the company is overvalued, just as it is at the moment at its current price. But you see the potential in this company. What I'm going to do is to start to pan across the share price. I will tell you what the date is today and where we are on the chart. I will then move the chart across to show time moving. I want you to pause the video when you buy into the company and write down the date in the comments below. Just put, I would buy in on date, and then put the date. Obviously, make sure you put in the actual date. Then continue the video and pause again when you would close. Go down and reply to your own comment with, I would close on date. If it gets to the end and you've not bought in, please add to the bottom, no suitable buying in price. And if you've bought in but you've not closed, then just reply, still holding. Then for a bonus point, see if you can guess the company name and put that as another reply, because if you put it in the main comments, other people might see it. Here we go. Well, that's all for today. Thanks for tuning in, and I hope to see you again in my next video. But remember, if you like this content, please make sure to like it and to subscribe. I'm only making this content based on the fact that you guys want to watch it.